for a really great future. We're talking real money.
You know, it seems like once a week, right about once a week, we get a Friday, that it becomes Friday. Once again, I think it's become Friday again, and that means if it's Friday, then I have to go find your questions that you've sent in at talkingrealmoney.com and recorded using your voice and answer them on the Friday Talking Real Money Q&A podcast, of which this is one of many. So there you have it. Welcome to the show. I'm Don. Glad you're there. And once again, we have a nice variety of your questions and my answers to share on this last workday of the week for many. So, if you want to send in your questions, go to talkingrealmoney.com, go to the contact form, type them or speak them, preferably speak them, or call us on Saturday afternoons when we do a live show in Seattle on the radio that becomes a podcast, and that number is 855-935-8255, and you can call between 3 p.m. and 5 p.m. Eastern Time. Now, let's get to our first question, shall we?
Hi, Don. This is Natalie in Greensboro, North Carolina. I'd like to get your take on Fidelity's fully paid lending program. I recently came across this as an option for additional income that can be made off of an investment account or retirement portfolio. Is the potential reward worth the risk? I'd like to get your take on that. Thank you in advance. Love your show.
Interesting. I think this may be the first call on this. First one that I remember, but I'm getting old. I think in most cases it's the income is likely to be so small from this program. Here's what it is. If you have stock or ETFs in a Fidelity account that are fully paid for, you can lend them to Fidelity so that Fidelity can lend them to someone who's short selling, for example. You get a piece of what Fidelity gets in fees for lending that stock out. And it can stay lent for a very long period of time. You still make the income in one way or another from the dividends, and it's still your stock. You own it. It's yours, and you can cancel the contract whenever you want to. But is it worth it? If you invest in the way we suggest you invest, which is through exchange-traded funds, probably not. It's just not that much incremental income. I mean, I guess if you're of the school that every little bit helps, then maybe. If you have individual stocks, some of which are really difficult to borrow, like a very small company stock, you could make pretty decent money. I've seen anecdotal reports on very small, lightly traded, hard to borrow stocks of returns to the Fidelity program participant of the equivalent of 20% or so a year. Whereas on ETFs, the reports I've seen show it at about 0.2% or 0.25% a year in return, which is negligible. So might it be worth it? Yeah, it might. Is it likely to be a big deal for most? No. Thanks for your question. Now let's go to another one.
Hey, Tom and Don. This is Jeff from Prosper, Texas. Love the show. First, thanks for curing me of the terrible case of hodgepodgeitis I once suffered from. I'm almost back to normal. I really appreciate all the great advice you guys share. And now, even though I can't stand the sound of my own voice, I'm answering Don's call to action and stepping up to the mic with a question. Our primary home, we've got a balance of $268,000 on a 30-year fixed mortgage with about 305 payments left at a 2.625 interest rate and a monthly payment of $1,206 of principal and interest. My wife says we should pay biweekly and cut down the interest, but I'm leaning toward investing that same money instead. Assuming around a 7% rate of return and factoring in our 22% tax bracket, I consulted my good friend ChatGPT, who tells me that paying biweekly would save us $11,000 in interest, but investing that money would generate around $31,000 after tax return. So from a pure ROI perspective, which is better, And are my numbers right? And more importantly, can you guys help me finally score a marital victory and earn those sweet, rare words of success? You were right.
All right. I may disappoint slightly on that score. Maybe. Because financially, you are 100% correct. You really are. There is no competition in today's environment. Right now, you can, without breaking a sweat, with zero risk, which is the more fair comparison, really. You can earn 4% while you're paying 2.625. So that means that your net benefit, pre-tax net benefit, is close to 1.5% per year. That is great, no-risk money, and that's the climate we're in right now. I would say a 7% return is not necessarily a really fair comparison, although if you are comfortable with the risks that entails, and it sounds like you are, then yeah, you should, in that scenario, make quite a bit more than you're paying on the mortgage. I am not a big fan of paying off a mortgage that is below 5% per year in any case except one in which it provides a gigantic emotional boost to the person accelerating the payment. From an emotional standpoint, your wife is probably okay. From a financial standpoint, you, sir, are entirely correct, and I've run the numbers, and you're right. Yes, she should say you're right, dear. Now to the next call.
Hello, Tom and Dawn. I want to let you guys know that you guys have great voices. I just love listening to your podcast. But I have a question for you. Why don't you simplify investing for most people and tell them just to buy Berkshire Hathaway B share stock? Since the year 2000, it's averaged almost a return of 9% a year, almost actually 10% a year, and it doesn't put out any dividends, so there's no taxes, and just keep buying that, and it virtually doubles every 7 years. I think if most people did this, they would be big winners. They could always sell a few shares here and there if they needed cash, but it's almost the most perfect investment vehicle I've ever seen. I've been doing it really since the 80s and have been very, very happy. I actually own some A shares, but recently, over the last 10, 15 years, I've bought B shares, and I've told all my children to do it as well, and everybody's very, very happy. So I know this is against what maybe brokers would want because it's too simple, but it's a perfect investment. And even after Warren's gone, it'll stay perfect, I'm reasonably sure. They have very little debt. They own many companies over a wide variety of industries, and it really can't be beat. I'd like to hear what you guys think. Thank you very much.
Well, thanks for the comments. I do take exception of your use of present tense. Not just yours, though. Everybody's use of present tense. Berkshire Hathaway is not doing anything. It has done things, and it has performed admirably. But the biggest returns came in the earliest period. In fact, Warren Buffett himself has said on multiple occasions that he would suggest that most investors get an index fund instead of Berkshire Hathaway. He's also said that going forward, matching the results of the past is going to be increasingly difficult. He himself has said that because he himself knows that Berkshire Hathaway, while it has performed really well, as big as it is less likely to continue that torrid pace in the future. He's a smart man. The other thing, you state with absolute certainty that those who come after Buffett and Munger are going to be just as good. I take exception with that because, well, most people, most acquirers of companies, most managers of portfolios have failed to do as well as just their benchmarks. I think it's more likely that the performance you saw, and I think Warren Buffett agrees, is not normal and should not be expected going forward. I think it's a mistake to say we expected going forward. The risks of Berkshire Hathaway, by the way, are much higher. It is a much more focused portfolio in just a few industries. So therefore, it's likely to have higher inherent risk and higher long-term volatility risk. So I'd rather see our listeners in something even more boring than Berkshire Hathaway, lots more boring, just a total market index fund or something very similar to that. Thanks for your input, though. We really appreciate it. And remember, you can send your questions in at talkingrealmoney.com on the contact form, or you can call us on Saturdays at 855-935-TALK between 3 p.m. and 5 p.m., and we'll have a conversation. Now back to our Friday Q&A. Next question.
Hi, Tom and Don. I love your show. I've got a question for you. I'm 42. My husband's 48. And currently, all of our dedicated retirement savings, which is just shy of $800K, is located in the same account, which is my employer-sponsored traditional 401k, which I always max out every year with an employer match on top of that. It's invested in a target date fund at Vanguard, and I recently learned that my employer also offers a Roth 401k option, as well as the traditional 401k. I don't know that I've heard you guys talk much about Roth 401ks before. Should I start designating the amount that I invest every year into the Roth 401k option instead of the traditional 401k? Are there downsides I'm not seeing, aside from the taxes on the front end? My husband and I make too much money to open a Roth IRA, so we don't have one. And I started to realize that a blind spot in our current plan is that everything is in the pre-tax bucket with all the downsides that that's going to entail down the road. My husband does not have any tax advantaged options on his end because of the way his business is structured as a business owner. Any other ideas you've got on how to diversify our nest egg so that it's not all sitting in a traditional 401k in a couple decades would be greatly appreciated. Thanks so much for all you do.
Thanks for all the kind comments. This is another one of those questions where the correct answer is, it depends. This is why we are such sticklers for having a plan, because it's so important that you have some idea as to whether your current tax situation, your current tax bracket is a lot higher than it might be when you retire. If it's a lot higher than when you might be when you retire, then not using the Roth, using the regular tax deductible account probably makes more sense because you're earning money on money you would have been taxed on, because you don't get a tax deduction. You don't get to reduce your income, your taxable income, with a Roth. You do get growth without taxes forever, which is nice, and it might be a nice thing for a portion of your money going forward. Might, again, but plans really do come into play here. Now, you mentioned that your husband is self-employed. Well, there are options, retirement options for the self-employed, including both regular tax-deductible accounts and Roth-style accounts, depending on what kind of business and what his situation is. At the very least, he could have his own IRA. He could do a non-deductible IRA and turn that into a Roth using a backdoor Roth IRA. So there are options, and maybe that's the way to go. Maybe he does a backdoor Roth by making a non-deductible Roth contribution. Making a non-deductible IRA contribution, and then immediately transferring that into a Roth, because it doesn't sound like you have other IRAs that will be subject to the pro-rata rule. Because all of your retirement assets are in a 401k, then you don't have to pay any taxes on that. If you had other regular IRAs, you would, but in your case, you don't have those. So, in this case, a backdoor IRA into a Roth is probably the easiest, most sensible solution, and you just keep doing what you're doing, and he does the backdoor Roth. Just a thought. Or really, you're getting to the point. You're up around that $1 million. It may be time to start looking at a financial plan so you can get a better feel for where you might be when you retire in 20 some odd years. Thanks so much. Appreciate it. Now, let's take another one.
Hello, I'm Doug. I'm from Minnesota, and I wanted to comment on some of the things I've heard about HSA accounts. There's one thing I think is often forgotten when people talk about putting money into the HSA is if you do it through your paycheck, you end up not paying Social Security tax on your HSA contributions. I think people often forget that. This is kind of in reference to the person who commented that they use a Roth instead of an HSA. So again, they're losing the benefit of some of the tax breaks, not to mention the tax break on Social Security tax on your HSA contributions. Thank you.
Well, thank you for reiterating that. I mean, I know it, but we don't mention it. You're right. We should probably mention it more often because it's a pretty decent benefit. You don't get any reduction in your FICA contribution, your FICA deduction for a contribution to a 401k, but you do for HSAs. It's a nice little added benefit. So anything you put into that HSA is not going to be subject to that 7.5% FICA tax that we pay, and that's another benefit. It's a decent amount of money. So thanks for bringing it up and sharing it with everybody. And let's do our last actual question of the day.
Hey guys, love the show. You've taught me a lot, even in the recent time I've been listening. Such as one thing is stop paying on my mortgage. It's only 2.85% extra. I wanted to pay it off before I retired because when we refinanced, I was older, so it stretched out the timeline again. And I've stopped doing that, but I don't know where I should be putting it. My goal is to put it into, say, my Roth, and then in 10 to 14 years when I retire, pull it out and pay off the house early so I can retire without that bigger bill sitting over my head every month. I didn't know if Roth was the best place to be doing that or if I should be putting it somewhere else, like a regular brokerage. Again, I appreciate all the advice. Thanks.
Well, I think as a type of account, a Roth makes as much sense as any. It depends on your tax situation and what your needs might be for the money. But if it's retirement, long-term money, yeah, a Roth would make sense. Now, I might want to take exception, although I think you might consider this when you get older anyway. Don't count on paying that off when you retire. You'll find that, a couple of things. One, your needs and wants sometimes change as to where you want to live. So don't be in too big of a rush to pay it off. The other thing is, and this is also part of that first response, is when you pay off your house, that's money that's really hard to get your hands on if you need it. You got to borrow it, and you may have to borrow it at pretty ridiculous rates. Or you sell your house, and that can take a while, and people are sometimes disappointed. They're not getting what they expected. Houses are illiquid. They're not good parking places for capital. And if you still have that 2.8% mortgage when you've retired, you're going to find that monthly payment at that point in time probably seems pretty darn cheap and is probably being paid by the earnings from your investments unless rates change or returns change dramatically. So you might change that tune down the road. But you're smart to stop making the extra payments. Now put that into a Roth, a regular brokerage account, even a high-yield savings account will make you over 1% per year more than the cost of the mortgage. It's just that simple. Thanks so much for your call. Thank you for all the other calls. I'm going to call them calls because they're the closest thing we have to calls on these shows, except on the Saturday show when people actually call, which is making a phone call to 855-935-TALK on Saturdays, 3 to 5 Eastern Time. Otherwise, questions come in from our contact form at talkingrealmoney.com. You can speak them, you can type them. You can also, you know how I talked with some of you about how you might have somebody look at your stuff? Well, you might have somebody look at your stuff. And you can have somebody look at your stuff who's a fiduciary and is not going to try to sell you anything, I promise, for free from Apella Wealth, which is the company that Tom and I merged our company with many years ago. And we help people for free. We don't manage your entire financial life for the long term for free because we have bills to pay too, but we will help you. We'll look at your portfolio and say, or we'll go, you really need a plan, or you're doing great. If you're doing great, we're going to tell you you're doing great. If you have hodgepodgeitis, I almost mispronounced it, hodgepodgeitis, we're going to tell you that too and suggest ways to cure it, as we did with a previous questioner. Thanks for being there. I really, truly appreciate you. Join us 5 days a week for podcasts and Saturdays for radio. And we'll be back really soon talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Apella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor.
Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services.
Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.